Good day, grade 12 FABM students. This video is about income and business taxation. For our learning targets, at the end of this video, you must be able to explain the purposes and principles of taxation, define income and business taxation and its principles and processes, and explain the procedure in the computation of gross taxable income and tax due. What is taxation? Taxation is the process by which the government collects revenue in order to pay for its expenses. In the Philippines, the Bureau of Internal Revenue, or the BIR, is the primary implementing agency in charge of tax collection. There are many forms of taxes in the Philippines. A few examples of taxes imposed in the Philippines are value-added tax or VAT, income tax, real estate tax, and capital gains tax. We will limit our discussion to individual income tax. In this lesson, we will focus our attention on income tax. It is defined as the tax on the net income or the entire income realized in one taxable year. Both corporations and individuals are required to pay their income tax. For corporation, taxes should be paid on the 15th day of the fourth month following the close of the taxpayer's taxable year. This is the reason corporations following the December 31 calendar year end are required to settle their tax obligation by April 15 of succeeding year. On the other hand, requirements on individuals are based on the source of income. Employees who derive their income solely from compensation essentially pay their income tax dues periodically through payroll deductions. Their employers are withholding agents. This means their employers deduct income tax from their salaries and remit those to the government on a monthly basis. When you hear employees, for example your parents, talk aloud about their monthly withholding taxes, they are actually referring to income tax taken out of their salaries. On the other hand, some individuals derive income from the professions. For example, doctors, teachers, lawyers, and accountants, or from business. Income tax is computed at the end of each year. Payment of tax liability and filing of income tax returns are both due on April 15 of the succeeding year. So, who are required to pay income tax in the Philippines? According to Section 23 of the National Internal Revenue Code of 1997, the following are required to pay income tax. First, a citizen of the Philippines residing therein is taxable on all income derived from the sources within and without the Philippines. Second, a non-resident citizen is taxable only on income derived from sources within the Philippines. Third, an individual citizen who is working and deriving income abroad as an overseas Filipino worker or OFW is taxable only on income from sources within the Philippines. Provided that the OFW who is a citizen of the Philippines and who receives compensation for services rendered abroad as a member of the complement of a vessel engaged exclusively in international trade shall be treated as an OFW. Fourth, we have an alien individual. Whether a resident or not of the Philippines, is taxable only on income derived from sources within the Philippines. Fifth, a domestic corporation is taxable on all income derived from sources within and without the Philippines. Lastly, a foreign corporation, whether engaged or not in trade in business in the Philippines is taxable only on the income derived from the sources within the Philippines. The principles of income taxation in the Philippines require Filipino citizens residing in the Philippines and domestic corporations to pay taxes on their income wherever it may come from, whether from inside or outside the Philippines. Payment of taxes for income derived abroad does not automatically exempt this income from Philippine taxation. The country that levied taxes on your income should have a tax treaty with the Philippines, and you should have documentary proof of the tax payment to the foreign country. On the other hand, foreign citizens and corporations are only liable to pay taxes for income derived within the Philippines. Philippine individual income tax is progressive. The tax rate increases with the tax base. It is based on the principle that taxpayers with more capacity to pay should pay more taxes. The table of income tax rate is given below. If your income is not over 10,000 pesos, the rate will be the 5%. If it is over 10,000 pesos but not over 30,000 pesos, here is the computation. 500 pesos plus 10% of the excess over 10,000 pesos. If your income is over 30,000 pesos but not over 70,000 pesos, for your rate, you will have 2,500 pesos added to the 15% of the excess over 30,000 pesos. If your income is 70,000 pesos but not over 140,000 pesos, the income tax rate will be 8,500 pesos plus 20% of the excess over 70,000 pesos. If your income is over 140,000 pesos but not over 250,000 pesos, the computation for your income tax will be 22,500 pesos plus 25% of the excess over 140,000 pesos. If the income is over 250,000 pesos but not over 500,000 pesos, the income tax will be computed by 50,000 pesos plus 30% of the excess over 250,000 pesos. And if the income is over 500,000 pesos, the computation for the tax is 125,000 pesos plus 32% of the excess over 500,000 pesos. All individual taxpayers are granted a personal exemption of 50,000 pesos. Additional exemptions of 25,000 pesos are given for each qualified dependent, but only up to 4 dependents. For a married couple with children, only one spouse can claim the additional exemption for dependents. A qualified dependent is defined as a legitimate, illegitimate, or legally adopted child who is not more than 21 years old, unmarried, not gainfully employed, and chiefly dependent upon and living with the taxpayer. Also, a dependent who is incapable of self-support because of mental or physical defect, regardless of age, is still considered a qualified dependent. Let us now talk about the compensation income. Compensation income refers to the income derived by an employee. The employee-employer relationship is a critical factor. A consultant is a person working for a company, but is not an employee of the company. He does not enjoy the benefits given by the company to its employees, such as medical and dental insurance, and retirement benefits. So in this section, we will focus our attention to employees only. Employers are required by law to withhold income tax dues from their employees' salary. The withholding scheme is implemented because employees might not have sufficient cash to pay for their income tax dues if aggregated to a one-time annual payment. The withholding tax deduction is computed based on the employee's gross compensation, net of mandatory contributions to SSS or GSIS, PhilHealth, and Pag-ibig Fund. Tax status, timing of compensation payments, and using the published BIR withholding tax table. Taxpayers who derive their income solely from their compensation are required to file BIR Form 1700 as their income tax returns. However, to give relief to these taxpayers, BIR implemented substituted filing. Under the substituted tax filing system, the employer's annual information return of income taxes withheld on compensation and final withholding taxes, or the BIR Form 1604CF, shall be considered as the substitute income tax return of its employees. In lieu of BIR Form 1700, the employee may present BIR Form 2316 as their income tax return. BIR Form 2316 is a statement issued by the employer and signed by the employee but not filed with the BIR. For RMC number 12003, substituting filing is available only to those taxpayers who meet the following criteria. First, the employee receives purely compensation income regardless of amount during the taxable year. Second, the employee receives the income only from one employer in the Philippines during the taxable year. Third, the amount of tax due from the employee at the end of the year equals the amount of tax withheld by the employer. Next, the employee's spouse also complies with all three conditions stated above. Next, the employer files the annual information return, or the BIR Form number 1604CF. And lastly, the employer issues BIR Form 2316 version to each employee. Now, let us talk about the income derived from business or practice of a profession. The tax payments of business organized as sole proprietorships are made in the name of the owners. The owner is considered an individual taxpayer who derives income from business. He is required to file BIR Form 1701, and the business will not file a separate tax return. Sole proprietorships have no separate legal personality from its owners. A sole proprietor has two options. First, he can choose itemized deduction, in which case he will use the Statement of Comprehensive Income, or the SCI, that we have learned to prepare from the previous chapters of our lesson. However, the proprietor should have the complete set of accounting books and supporting receipts for the deductions that he itemized on his tax filings. The BIR may visit the business and examine its books. Next, another option for the sole proprietor is to use the optional standard deduction scheme. Instead of itemized deduction, the proprietor can claim deductions up to a maximum of 40% of gross receipts. Gross receipts is equal to net sales plus other taxable income. This means that the business taxable income is equivalent to 60% of gross receipts. Next one is the mixed income earner. Mixed income earner refers to a compensation earner who at the same time is engaged in business or practice of profession. Mixed income means the taxpayer derives his income from both compensation and business or practice of a profession. An example of mixed income earner is an executive of a multinational company who also lectures part-time for a university during the weekends. The corporation will withhold income taxes based on the compensation income, while the university will hold 10%, 15% on the lecturer's honorarium. A taxpayer deriving mixed income will also use BIR Form 1701. Here is the list of the BIR forms discussed on this lesson video. We have the BIR Form 1700 or the Annual Income Tax Return for individual earning purely compensation income including non-business or non-profession related income. Then we have BIR Form 1701, the Annual Income Tax Return. This is for self-employed individuals, estates, and trusts including those with both business and compensation income. Then we have your BIR Form 1701Q or the Quarterly Income Tax Return for self-employed individuals, estates, and trusts. Then we have BIR Form 2316, which is the Certificate of Compensation Payment or tax withheld for compensation payment with or without tax withheld. Lastly, we have BIR Form 2307 or the Certificate of Creditable Tax Withheld at Source. Thanks for watching this video. Please make sure to attend our Zoom meeting class for your questions, clarifications, and deepening of our discussion. Good luck and God bless you all.